I spent months turning volume price analysis into a repeatable system. And the weird part, the best trade is not when volume is high or low. It is what price does after the volume signal. This candle right here decides the whole trade. Here's the full blueprint. This looks like a massive breakout. The volume bar is green, the momentum is high, and every retail logic says enter long. But the moment you click buy, the floor drops. You just fell for a high volume trap. While you saw a green candle, someone with bigger pockets was secretly selling, and they knew something you didn't. I've analyzed thousands of these traps. They all leave the same 4 volume signatures. Now, volume analysis sounds complicated. It's not. Your chart speaks 2 languages at once. Price tells you where the market went. Volume tells you how many people actually believed it. Reading only price is like watching a poker player's chips without watching their face. You see the bet, but you miss the bluff. And one thing most traders get wrong immediately. They read the color of the volume bar. Red bar equals selling. Green bar equals buying. That's not how it works. You see, you're reading volume backwards. The color tells you nothing on its own. The size of the bar relative to recent bars and where the candle closes. That's the whole story. So forget the color. Watch the relationship between effort and result. Here's how. Volume and candle either agree or they don't. When they agree, the move is real. When they don't, someone powerful is hiding something. Look here, high volume and big candle, they match. So there's real conviction behind the move. Buyers showed up, price responded, the trend has fuel. Clean. Now here, high volume, but tiny candle. Now they don't match, and that mismatch is where the money is. A big money seller is sitting on the other side of every single buy order, quietly absorbing them all. Price wants to move, but it can't. When buyers exhaust themselves, when they've thrown everything at that wall and it still holds, price doesn't stay flat. It drops, fast, with nothing left underneath to catch it. This is an absorption area, and once you see it, every breakout on your chart either confirms itself or exposes itself within one candle. I admit I was reading volume backwards for many years. I bought many breakouts because the volume bar was the largest I'd seen all day. Confirmation, I thought. Now when I see a massive volume bar paired with a tiny candle, I don't see strength. I see a trap. This is your first binary rule. High volume plus a tiny candle, at a key level preferably. That's not confirmation. That's absorption. Look for the reversal, not the continuation. This next setup fooled many traders, and the volume told you everything 5 minutes before the move even printed. Price approaches a support level that's held before. The volume bar is the largest of the last days, but the candle, it has a tiny body and long lower wick. High effort, near zero result, a live absorption area forming in real time. I go long there, stop below the wick, target the previous swing high. Price reverses and moves to the target across 2 sessions. Every seller who read that volume bar as institutional confirmation got stopped out. Every trader who read the mismatch caught the move. What used to look like strong price action at a key level now looks like an obvious trap. The absorption area catches you at key levels, but there's a pattern that looks even more convincing. It shows up after long trends, and it's where institutions aren't blocking. They're actively heading for the exit, while the retail crowd celebrates around them. So price has been rising for weeks. News is great. Every trader is convinced the trend is real. Then a massive green candle prints. Extreme volume, the highest bar on the entire chart. Every indicator says buy. Every chat room says buy. And that's exactly the problem, because that is not strong buying. That is strong selling disguised as buying. Banks use that wall of buy orders from late arriving traders to unload their entire position without crashing the price. You need to stop trading these excitement candles. I went long on Apple on the largest green candle I'd ever seen on that chart. Volume was extreme. Momentum looked perfect. Everything confirmed. Lost $2,200. Now when I see extreme volume after a long uptrend near a key level, my first thought isn't, where's my entry? It's, this is a trap forming. This is your second binary rule. Extreme volume on an up candle after a long uptrend near a key level. That is not a buy signal. That is a warning. Reduce size, tighten stops, watch for reversal signals. This same pattern works in reverse during crashes, and it saves accounts. Pay attention here. Price is in free fall. Red candle after red candle, panic everywhere. Then the tallest red candle of the entire sequence prints with the biggest volume bar. Most traders read this as the sell-off accelerating. Look where the candle closes, not at the bottom. Long wick below, close in the upper half. Someone with enormous capital just bought everything those panicking sellers were dumping. Stop the crash with money, not words. Your third binary rule, wide range down candle, extreme volume, close in the upper half. Mark that as a reversal zone. Wait for the next candle. If it closes green on lower volume, that's your entry signal. That two-candle sequence is the stopping volume pattern, and it prints the bottom more often than any indicator you've stacked on your chart. Both of these show up as volume spikes, sudden, dramatic, hard to miss once you know what to look for. But the third signal is the opposite. It doesn't spike. It fades, slowly and quietly. And almost nobody watches for it because there's nothing dramatic to see. So price is making new highs. Chart looks clean, but the volume bars are getting smaller with each push. Each new high has less participation than the last. Think of a rocket at launch, full fuel, maximum thrust. As the fuel burns, the thrust weakens. The rocket still climbs on momentum alone for a while. Then gravity always wins. That's the fuel exhaustion. The move isn't over yet, but the conviction behind it is fading fast. And when belief runs out before price does, the reversal is sharp, because nothing was holding the move up. This will save your account. Don't hold through shrinking volume. I held a position in Visa because price kept printing new highs. Looked completely healthy on the candle chart alone. Volume had been declining for several days. I held anyway because the trend was technically up. $3,100 gone when the reversal hit. Now when I see price rising while volume is falling, I tighten my stop automatically. No discussion with myself about it. Your fourth binary rule, price making higher highs, while volume makes lower highs. Reduce size, tighten stop, and stop adding. If volume suddenly expands hard on a down candle while this divergence is active, that's the flush, the capitulation, usually the last move before the bounce. The fuel exhaustion reads in both directions. Price dropping but volume declining too means sellers are running out of energy. Each sell-off pulls in fewer participants. That often marks the bottom, not because buyers arrived, but because sellers left first. Divergence gives you several candles of warning before everyone else sees the problem. The chart still looks healthy. The trend is technically intact, but the fuel is gone, and you're reading it while retail traders are still celebrating new highs. A party where the music is still playing, but smart money left an hour ago. Nobody told the crowd to leave because nobody checked the volume. This next chart looks healthy on the surface, Clean trend, no red flags on the candles. But watch what the volume does underneath. It tells a completely different story. Clean uptrend, then a 3-day pullback. Day 1, medium red candle, volume drops below average. Day 2, smaller red candle, volume drops more. Day 3, tiny doji, volume is essentially zero. 3 consecutive days where the market asked, does anyone actually want to sell here? And the answer was silence. Sellers didn't show up. The pullback wasn't real distribution. It was air. Next day is a green candle with decent volume. So by the open of the next day, stop below the day 3 low, target the previous high. The traders reading both languages at the same time were already positioned before the breakout hit anyone's scanner. Every one of these patterns works harder when you stack them. Ask these questions before every trade. Is volume increasing or decreasing compared to recent bars? Does effort match result? Remember, big volume should make a big candle, and if it doesn't, someone's absorbing. Any unusual spikes near key levels? Is price diverging from volume? New highs on shrinking bars. 30 seconds of extra work filters at least half the losing trades. That's because they force you to read what the market is actually saying, instead of what you want it to say. 5 patterns, that's all you're looking for. When you see them, you know what's coming. It all starts with this. Volume is supposed to be the engine. Price movement is supposed to be the speed. Wyckoff, a trader in the 1920s, watched the biggest money in the world, and he documented exactly how they moved markets. One thing he found, prices don't move randomly. They move because of effort versus result, supply versus demand. When those two are in sync, the trend continues. When they clash, reversal is coming. This is called VSA, volume spread analysis. You read the candle spread, how much price moved, and you read the volume bar below it. Then you ask one question. Do these two agree? If they do, trend is healthy. If they don't, reversal is already forming. This is how a volume price mismatch feels like on a chart. Your brain expects one thing based on the candle. The volume says something else. Red candle, you expect high selling volume, but you see low volume instead. It means no conviction, potential reversal loading. Now this one, red candle with massive volume, but the spread is tiny. Everyone's selling, price should drop hard, but it doesn't. Someone's buying everything. That's absorption. So one rule from this, volume confirms or contradicts. When it confirms, good. When it contradicts, mark it. That contradiction is your potential next trade. So stop reading price without volume. I did this for my first 3 years. Now when I see a candle, volume is the first thing I check. Look here, a high spread candle moving down looks like strong selling. Your brain says, sellers in control, don't fight it. And that's exactly what the institution needs you to think. Because they're on the other side of that trade, building a long position. A large bearish candle with low volume means the sellers didn't actually show up in force. Price dropped, but the effort behind the move was weak. That mismatch is the signal. It's not confirmation of the trend. It's the warning that the trend is exhausted. Remember this. Every time effort and result are out of sync, somebody with more information than you just made a move. Your job is to figure out which direction. If the candle spread and the volume bar are both large, trend is continuing. Stay away from counter-trend trades. If the spread is large, but the volume bar is small, or the spread is small but the volume bar is massive, that's a mismatch. And a mismatch means the next move is the one worth trading. There's a name for what just happened on that chart. Banks call it absorption, and they show their hand through these next specific candle patterns. Learn these, and you're done guessing. This is a bullish pin bar or a doji, low spread, but the volume is very high, higher than the average volume. So what's happening here? Sellers pushed hard. They forced price down. Volume exploded as they sold. But then buyers rejected it. The close is near the high. Sellers used all their ammunition. Volume exploded downward. But they lost. Price didn't drop. It stayed up. Here's the chart. Watch this candle. Classic pin bar with buyers stepping in. Close back above the open, near the high. And next 3 candles. Strong upside. That first candle was the reversal. This is the down thrust rule. If you see a bullish candle with a rejection wick and volume is higher than the average, demand just overpowered supply. Now the next pattern is even more obvious once you know this one. It's the one that shows capitulation. High spread bearish candle, very high volume, but there's a big wick at the bottom. This is a rejection. This candle screams capitulation. Sellers pushed as hard as they could. Volume was massive, but buyers said no, and they pushed price back up. Supply is exhausted. More demand than supply. And next move is up. This is called selling climax. Look at this candle. This one looks bearish, but watch what the volume actually says. Opens here, is getting pushed down. Then buyers step in. Massive volume. That's the selling climax. Supply dried up. Next candles move up over 40 pips. This is the selling climax rule. If a large spread bearish candle has a big lower wick and volume is at 90th percentile or higher, capitulation happened and demand is about to take over. This one is hidden and most traders miss it. Here we have 2 down candles. The first one moves price 40 pips and volume is normal. The second candle moves price 60 pips. Bigger move, but the volume, it's lower than the first candle. Sellers created a bigger move using less force. That's impossible if they're in control. It means they're exhausted. Bearish effort, lower than bearish result. This is the pattern. Look here. First red candle pushes down 20 points on high volume. Second red candle pushes down 40 points, but volume dropped a half. That disagreement between price and effort means sellers are done. Next candles reverse up. It's like a boxer throwing a bigger punch while running out of breath. He put more into it, but he's got nothing left. Next round, he gets knocked out. Here's your rule when you see bearish effort, lower than bearish result. If a bearish candle is bigger than the previous one, but volume is lower, supply is drying up, and reversal is next. Now flip side. 2 down candles. First one pushes price down 60 pips. Volume is normal. Second candle, higher volume, but only moves price down 20 pips. Sellers are pushing harder, but price won't budge. That's not weakness in price. That's weakness in sellers. Buyers are defending. Bearish effort higher than bearish result. That's the pattern. Another one. First red candle, 40 points down, moderate volume. Second red candle, volume spikes, but price only drops 15 points. Buyers just took over. Strong upside after this. Everyone sees the higher volume and thinks more selling is coming. That's actually wrong. Higher volume plus lower price move equals sellers losing. That's the opposite of what it looks like. So the rule is, if volume spikes on a bearish candle, but the move is smaller than the last one, buyers just took control. This next pattern is so powerful that when it shows up near a key level, the move is almost guaranteed. But most traders think it's the worst entry point. Watch what happens. low spread bearish candle with a downward wick, lower volume than the previous two candles. Sellers just disappeared. Supply dried up. They're gone. This one looks like a losing setup to most traders. That's why it works. It's a weak candle on low volume. Looks dead. But dead supply means price has nowhere to go but up. Pay attention here. 3 candles down. Volume is dropping with each one, is practically evaporating. Sellers have abandoned this move. Next candles, strong rally. What used to look like weakness now looks like strength because the chart shows you exactly where sellers have given up and buyers are about to take over. This is the no supply bar rule. If a bearish candle has lower volume than the previous 2 candles and a downward wick, supply is exhausted and buyers are about to run. These 5 patterns are literally banks showing you their next moves. They're not hiding it. They're broadcasting it through volume and candles. You just have to read it. Here's the setup. I'm using the daily chart. It's an uptrend, but price has been dropping for 3 days. For now, sellers have control. This candle right here is also bearish and creates a wick. But look at the volume, lower than the previous 2. That's pattern number 5, no supply bar. This is the exact moment I'm getting ready to enter. Most traders see the downward candle and think keep shorting. I see low volume and think buyers are about to take over. Watch what happens next. Price opens the next candle up with higher volume. Price and volume are in harmony once again. This is where I enter. Stop is below the no supply bar. Target is the last major level where price bounced before the sellers took over. One pattern, one decision, in or out. Look here, price has been pushing lower in a clear downtrend, several lower highs, several lower lows. Retail consensus is short. Nothing on the surface suggests a reversal is coming. Watch this candle. Large red body. Spread is wide. Volume bar towers above everything around it. The wick pushed below the previous swing low and closed back above it. That's the selling climax signature. Wide spread, extreme volume, rejection wick reclaiming the low. 2 candles later, small red body. Spread is clearly smaller than the selling climax candle. Volume is higher than the candle immediately before it. That's bearish effort, higher than result. Sellers pushing hard, price refusing to move. A few more candles later, tiny red candle, small down wick. Volume is lower than both preceding candles. Supply bar, sellers gone even more quiet. 3 signals across 10 candles, all pointing the same direction. These stacked signals are stronger than any single pattern in isolation. At the first sign of bullish pressure, big bullish candle on high volume, I'm in. Stop below the climax low. Target the next resistance cluster. These 5 candle patterns expose the manipulation, but they don't tell you what comes after. Just that a reversal is loading. The Wyckoff method does. It maps the entire cycle from accumulation to distribution. 4 phases. Banks move through them in sequence. And each phase has a specific candle structure that marks the beginning, the middle, and the end. Once you know the phase, you know the trade. That's the next video. And this is exactly the kind of setup we break down inside our academy. See you inside.